Hello, I'm Ryan Lightfoot Brown of Fund Caliber. Today, we're joined by Marty Flood, co-manager of the Lazard US Equity Concentrated Fund. Marty, thank you very much for your time today.
Thank you for having me.
Now, the US has been in the headlines for all sorts of reasons, none more so than the election, where Donald Trump seems as if he's starting to concede defeat now. With that in mind, what does a Biden presidency mean for US companies? Does this bring new opportunities or new risks for investors?
Well, it probably will in the short term, probably leads to a little bit more volatility, and that should give us some opportunities. I mean, we only own around 20 to 25 stocks at any given time. So when we have more volatile markets, that presents great opportunities for us to take advantage of it. I mean, I do think Biden obviously is the president-elect, and eventually Trump will formally concede. He has not done that yet. He's still, trying to file various lawsuits to allege election fraud in certain states. But most likely, from everything that I've read, and probably the same that you've read, is that this will go through. And their key really will be what happens in the Senate in Georgia. Could really tip the balance. If that doesn't go where we have a full blue wave, I would say it's more status quo, and that's at least how the markets are reacting. I don't think Biden is that far to the left, or we as a firm don't think he's that far to the left where if a Senate stayed Republican, then you probably get more moderate change. So it's, gridlock is something we've dealt with in the States now for probably 20 years. And it's probably more of the same. At least that's how the market's reacting right now. So how we're handling it is just a balanced approach. We don't want to bet the portfolio in any political direction one way or the other. In fact, that's one of the hallmarks of the strategy is that we try and stay balanced and not have any one theme populate our fund and try and own 20 to 25 equities that each do something different as opposed to betting on one outcome. If Biden wins, I would expect more fiscal stimulus, but that might be passed prior to him actually taking office. That would be something in the next couple of weeks, and that would be good for the markets. If that's probably the most likely outcome, some type of compromise around that front. At least that's how stocks are behaving right now. And it's been a amazing year that you wouldn't have thought markets being up what they are. I mean, well, it's really dominated by tech. But even without tech, you still have the Dow up at low single digits, the S&P up a little bit more than that, and the Nasdaq up significantly more than that, driven by growth equities. But yeah, it's been an interesting time this year, and we're just going to try and stay balanced and react when we can. But right now, we feel pretty good about how we're positioned.
And you touched on it a couple of times that you only hold just 20 to 25 names. I mean, you really are living up to your concentrated name there. How do you pick just such a few number of companies from the thousands of listed stocks there are in the US?
Well, when we launched the strategy in 2003, we had a platform of roughly 250 equities that were owned across various funds, small, mid, large, and you could say even mega cap back then, but whatever that might have been market cap wise. So when we launched the strategy, it was about trying to get different from the index and not be focused on the index. It was sort of lessons learned from the late 90s. I would argue that's where we are today right now. Maybe the difference being that the companies that dominated the market actually make money, as opposed to the late 90s when it was more concept type names, the dot-com bubble that eventually burst. So lessons learned from that period, we were like, why not run a more focused strategy that would not be index aware or even, index focused? And we looked at some of the more concentrated, successful managers that were out there, one of which was Warren Buffett. And Warren Buffett created a holding company, it's known as Berkshire Hathaway. At the onset, it was just a handful of companies that he owned, some private, some public, but he used the framework for equity investing as a holding company structure. And we thought that would be a successful way to run a fund. So we kind of created our own version of that by doing it only in the public markets. So everything we own is liquid, and we run our fund as if it's a business, and we think about each stock as a subsidiary to that business. When we first launched, we had roughly 30 to 35 equities. Post the global financial crisis, we've narrowed that list down to around 20 to 25 is where we've got in our comfort zone. And if you back into how we think about position sizing, and alpha generation expectations in the portfolio, because of that position sizing framework that we have, you kind of get back to that 20 to 25 name limit because of how we put larger weights in certain stocks. So our bigger positions tend to be between 5 and 10%, and we might own somewhere between 7 and 10 of those. Our less conviction names, maybe more upside, tend to run somewhere between 3 to 5% position sizes. So when you use that as a kind of the range of outcomes and the range of position sizing, you kind of get to that 20 to 25 name. And when there's more volatility in the market, you would see us change more of the fund. And that actually occurred back in February, March. It's the highest trading that we've seen in years. Whereas in the third quarter was the first time in 17 years we didn't make a trade, a buy or sell. So we felt like, although performance is not good right now relative to the benchmark, we feel like we got a fund that's set up to do really well as things improve and the economy regains its footing. So that's sort of where we're at right now.
Okay, thank you. As I was speaking of those big benchmark names, so it's obviously the US tech giants taking up huge amounts of that. You only hold one of those in Alphabet, which is the parent company of Google. Why is it only this company that you find attractive, or do you just think this is the best opportunity that there is?
No, it's our investment philosophy is a sort of a value-based philosophy. So we look at valuation relative to the term we use internally is called financial productivity. The easiest way to think about that is return on equity or return on invested capital, either one of those measures, or operating margins or cash flow consistency. So it's a kind of a trade-off or a relationship between valuation and productivity. And for many of the big tech companies, and we've had exposure to them in the past. So it's not that we've never owned them, but they, in many cases, they hit our kind of base case or even bull case price targets. Names like Microsoft would be an example of that, which we did own at one point. And in hindsight, would have been a better move to hold on to it, right? So hindsight's 2020, but that's the reality. We probably could have continued to own it because you're now looking at 3 companies that comprise 15% of the index, and the 5 largest tech companies are larger than the stock market of every developed nation in the world. It's just amazing. The law of numbers is astounding, and the heavy or the narrowness of the market is at a level that I don't think we've ever witnessed in history. And that's also plays into style. The growth style is outperforming the value style by a margin that is even worse, spread than what we had in the late 90s with the tech bubble. So the reason why we haven't owned them is not that we don't like the companies. I would definitely not be someone that would be short if you wanted to be a hedge fund manager. I would not be short many of these big tech giants. But when we balance valuation relative to financial productivity, we think there's better opportunities outside of that small group of stocks. And people that focus on the returns of the NASDAQ, let's just say year to date, you back out those names and the actual returns are pretty modest. So there's, from a valuation standpoint, from a return looking forward, we think there's much better opportunities in some other companies that are right now being overlooked. And I think in addition to that, you do have there's a couple of things there. For the growth managers, you have to own almost 35% of your fund in 3 or 4 stocks to outperform the index, just to be index weight if you're a growth manager. And the names, the Amazons of the world, or Google, Apple, Microsoft, Netflix, a handful of other names. And the trend in the market right now is either growth, which somewhat makes sense because there's no growth in the world, so you might as well pay up for whatever growth that you could get. And interest rates are negative to zero on a global basis, so it sort of makes sense. And the other side of that trade has been sort of like social distancing. Anything that relates to, like, we're all on the line right now working from home, so anything that benefits from that trend, and then anything that is the perception that are not benefiting that trend, you avoid. So there will be opportunities to separate winners from losers in that camp, and that's what we're trying to do. There are a few examples of names we benefit from in the fund on the work from home or the social distancing argument, but the concept type stocks or the healthcare names that are binary type scenarios, we don't take that type of risk in the portfolio.
Sure. Well, actually, one quite well-known name that is in the portfolio and quite a big holding is McDonald's. What is it about that company that you like particularly? Obviously, many of our listeners will know it. Some care to admit it more than others, but what is it about them in particular that you like?
Yeah, we bought McDonald's as part of, well, this is pre-pandemic. We bought McDonald's as a result of the changes that they were making in terms of the store layout. And this began in Europe. And you probably recognize the speed at which you could order what you'd like and the convenience factor that was there. Yeah, I'm not, I'm not one to go to McDonald's weekly, but there's plenty of people that do. In the U.S., the average American visits a McDonald's pretty much every week. I mean, so it's a tremendous franchise. They're moving more to that franchise model, which is less capital intensive. They've reformatted the stores. During this particular situation that we're all in right now, they've actually improved the response time for people to go through, drive-through. And you see that, you see the direct impact of stimulus checks and McDonald's drive-through lanes. It's almost correlated 100% in terms of where people are spending their money. And they've seen, that's one of the examples of social distancing. So, I mean, right now with the issue that's going on in the world, that's a way to feed yourself at a pretty modest price and not have to have the experience of actually dining in. And you could see this play out throughout, at least in the U.S. You could see this in, you kind of like put stocks on I'm an ex-accountant, so I used to use a ledger way back when there was actually paper. And I'm dating myself, but on the left, if you put a ledger out, left-hand side, you could put COVID beneficiaries, and the right-hand side, you could put pandemic, issues that would negatively impact them. That's sort of how the stock market has been playing out in the U.S. since February, March. And McDonald's will be one that is a beneficiary of that because of the convenience factor and the quick service restaurant, format that they follow. So beneficiaries on one side benefit from the convenience and the ability to get in and get out, and then ones where you don't have that are the ones that are getting treated the way they are in the stock market. So, and that plays out every industry. You could almost put on that kind of comparison.
That's really interesting. Thank you. And now perhaps going sort of more big picture, what's your outlook for US companies in 2021? Do you think it'll be a good year? Do you think it'll be a year where the tech stocks will dominate again? Or do you think there'll be a bit of a change of leadership?
I mean, we build in scenarios for every stock that we own, and these scenarios are updated every quarter. And we have a base case is where we put most of our assumptions. And the base case, and we probably weight each of our assumptions. So base case for the most part is around 60% of our assumption. And then we build a bull case, the optimistic outcome, and then a bear case. And then the range of those outcomes drive how we think about position sizing. So the tighter the range, the more likely these would be our 5 to 10% positions. So our biggest position right now is Medtronic, and that is the leading medical device company in the world. The various ailments they treat, you really can't choose. Your heart, for example. But due to what's recently transpired, that actually became elective. Things that were not elective became elective because of the uniqueness of what we're all dealing with right now. But that being aside, this is a business that should have pretty consistent earnings, revenue, regardless of where the economy goes. So the range of the outcomes, although they were widened out as a result of recent events, are pretty tight. And that's our big and that's sort of our biggest weight within the fund. And because of that level of conviction, the range should be fairly narrow. And long with an answer to get to where you're going, but the range of the outcomes drives our position sizing. When we put it all together, as it relates to the market, we kind of get a sense of what the weighted average upside is to the portfolio. Now, it's all based on our analyst opinion on each of these stocks, but at times the weighted average doesn't all look that appealing. I mean, in fact, a year and a half ago, the weighted average was almost on a base case was about 0%. So we didn't really see much upside in the portfolio other than using a higher multiple or more bull case assumptions. This is, 18 months ago, let's just say. Where we stand today, or even as of last week, in terms of the market, the weighted average upside was one of the highest that we've actually witnessed. And I think that's, twofold. Number one, you have a major recovery of earnings coming, assuming not a worst case scenario. So we have 2 vaccines approved or in the approval process, and 3 more in waiting. So now you have 5 solutions to this problem. You have fiscal stimulus coming through. And so there's a lot of pent up, I think, earnings growth for many of our holdings. And the fact that we've trailed, let's just say, since the market bottom, the market's up probably 60+%. And we've lagged a little bit. We've lagged by a decent amount. Most of that is by what we didn't own. We didn't own Microsoft and a few other tech names. And that's pretty much all of our underperformance. It's not like we've bought businesses that have had their longer term outlook impinged. So I feel like we got a lot of great upside from here. And when I weight the overall upside of the fund right now, taking on a base bull and bear scenario across the fund, the weighted average upside is almost the highest it's ever been. So you're talking north of 20%. And this helps us gauge a new idea. So if we have a new recommendation from an analyst, well, the bar is pretty high right now to get a new name in the portfolio. And therefore the actual trading in the fund has dramatically slowed. Since roughly May, we've only done, I want to say we've done 4 trades, but in the third quarter there was 0. So if you want a strategy that is not benchmark aware, that is not the big tech companies, and is taking advantage in the volatility in the markets to be different than the index, that's where we're at right now. And that's why I feel as confident as I do. It's good timing. I think if I was not an investor in the fund, I think this is the time to at least allocate some capital to U.S. equities. So I think overall, from a recovery standpoint, we feel pretty good about investing in U.S. equities.
That's excellent, Marty. Thank you very much for your time. It's been so interesting.
Great. Well, thank you as well. I appreciate the opportunity to speak.
Thank you very much. And if you'd like to hear more about the Lazard US Equity Concentrated Funds, please visit our website, fundcalibre.com. And to make sure you stay up to date with all of our content, please don't forget to subscribe below.